Now, who doesn't know Charlie Munger? He is without a doubt one of the most respected names in the value investing world. At 99 years old, he still acts as vice chairman of famed holding company Berkshire Hathaway, and Charlie Munger is Warren Buffett's right-hand man for decades. He's also a very successful investor in his own right, with a net worth of $2.3 billion, and a huge part of his investing success has been down to his rational thinking and his ability to tell it like it is. And to our benefit, that's something that he's done quite a bit over the past few years. So, with the stock market falling 20% in 2022, inflation's still really high, and interest rates set to continue rising this year. Let's take a look at Charlie Munger's advice that specifically applies to the investing scenario we all face in the year ahead. So probably the most obvious investing challenge we face this year is the fact that it looks like we're going to be investing in a down market, as the S&P 500 fell 20% in 2022 due to interest rates being hiked up to 4.5%. Now this year, it does seem as though interest rates will continue to rise due to the Fed reaffirming to meet their target of getting inflation back down to 2%. Now the first question is, should we even be investing right now? Is it worth considering? There might still be tougher times ahead. So what is Charlie's approach? Now Charlie says that economies see booms and downs, and you have to live your life through both episodes, so you just keep swimming, and sometimes the tide is with us, and sometimes against. But we keep swimming either way. So, sometimes the economy is working for you, and sometimes it's just against you. But hey, if you are a long-term investor, you must not really care if prices go down a lot in the short term. Now, such times must be used and seen as long-term opportunities. Timing the market is actually not a good idea. So if you're invested right now, you know your 1-year return might be questionable. But what's your 10-year return going to be? Charlie has been saying this stuff consistently for a very long period of time. Even in an interview of 2008, he shared that he is never worried about the decline in market, as he and Buffett have seen their holdings in Berkshire go down thrice, from top tick to bottom tick by 50%. He says that it's the nature of long-term shareholding with the normal vicissitudes and worldly outcomes, and in markets, the long-term holder has his quoted value of his stock go down by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a marketplace decline of 50% 2 or 3 times a century, you're not it to be a common shareholder, and you deserve the mediocre result you're going to get. There's this straightforward advice of Charlie that has earned him well-deserving respect for right in market. Think about that if you're not willing to react with equanimity or composure. When you see the decline of your holdings by about 50% of the market, you're not fit to be a common shareholder, and you deserve to cop bad returns, and that's because proper value investing is all about finding good businesses and holding them for a very long period. That's the truth behind how most stock market fortunes are made. There's no waiting for the best times. There's no speculation. There's just buying high-quality companies, staying invested through them, through the good times and the bad times, and then using those bad times specifically as long-term opportunities to buy. But of course, being able to do that takes an unbelievable amount of emotional intelligence, and you really have to train yourself to get to the point where you genuinely feel indifferent whether the stock market is booming or crashing. Now, the best tips to help with that are firstly to really understand your own strategy. So, know what it is that you're trying to achieve, have a clear goal in your mind and what you need to do to get there. And then on top of that, you really have to understand the businesses that you've bought, and if you can actually commit to a long-term strategy and you understand what you own. Charlie said about this odd kind of indifference to the market conditions that treats success and failure just the same. You just roll with it. Sometimes it's going for you and sometimes against you. It's all part of the same game. Just roll with it. Make smart long-term decisions and take advantage of market drops, and you'll be all right. So next time, if someone tries to convince you to run away from the stock market, or maybe to invest in some fancy new cryptocurrency, or to focus on the next 12 months because that's where you're going to make bank, just remember what he said. Now, investment is more about getting more value than you pay for, and it's never going to be obsolete, and that's how you're going to be more successful. Now, you can get a whole body of people that don't even know what they're buying. value investing can never die. We think long-term, we find high-quality businesses, and we buy them in moments like what we're seeing right now. The rare occasions where the stock market is down a fair chunk, but okay, let's get a little bit more specific. Because if we look at our current situation, we've got rising interest rates, which are going to make stocks suffer probably again this year, and on top of that, we've also got persistent inflation to deal with. So, what's Charlie's specific advice to applying value investing principles in a situation like this? How will this all play out, and what's the best advice for individual investors to optimally deal with the negative impact of inflation other than owning quality equities? Now, Charlie says that you don't need damn diversification. You're lucky if you've got 4 good assets. Though the finance professors sell the idea that perfect diversification is professional investment. Now, very few people have enough brains to get 20 good investments. You know, sometimes the market is full, and sometimes it is against, and it may be that you need to do the least bad option while inflation is roaring and rates are rising. Well, that's a tough position for any investor, chances are. You won't be making 2021-style returns this year with rates of 4.5% and going up. But as Charlie says, the lesson from the Mungers is just to buy good assets and just stick with them. Now, you don't always need to be chasing, 20 annual returns every single year. That will drive you absolutely insane, and remember, most of value investing is literally just sitting back and waiting. As Charlie and Warren say, if you have 1 or 2 opportunities a year, that's plenty. And usually it's the people that overly complicate things by trying to get in on every single deal. They're the people that eventually run themselves into a mess. So with that said, what type of businesses should we actually be keeping our eye on through tough times like this? Well, this is how Charlie sees it. He quotes that Warren says that at times, you have to choose good person or good business, and this is not politically correct. We like businesses that stand a lot of mismanagement, and it has a way of staying tough. He says it's the reputation of the business that remains. If they start tough, they stay tough. That's probably the number one thing to take away from investing in this kind of environment, or really in any kind of environment. You want tough businesses, ones that are very robust, they can handle the tough times, and still be okay. It can handle bad management and still be. Okay, now what does that actually mean? Well, it means, firstly, that the business has an intrinsic durable competitive advantage. It means that it isn't overly reliant on debt, hasn't swamped itself with loans that could topple the business. It means that the business model works and the company generates healthy profits in any conditions. And finally, it means also that it's simple. As Charlie said, you want a business that an idiot could run and it would still be okay, because chances are, if you're a really long-term shareholder at some stage, an idiot will run that company. But if it's a robust business, then it should be able to handle a little bit of mismanagement, and that's really important. So overall, guys, there are Charlie Munger's tips for investing in 2023. No doubt it will be quite a challenging period, but if you can remain emotionally indifferent to the market conditions, if you can invest with a long-term mindset, if you can be patient for opportunities, if you can keep it simple, then you've got a pretty good framework to come out ahead in 10 years' time. So, with that said, that's it for today. If you enjoyed this video, don't forget to like and subscribe. Thank you for watching, and I'll see you guys soon.